Hey, what's going on? Glad to have everybody today. So today's gonna be a little different. I'm gonna try to ease through this investment thing and see if we can get everybody spun up on it. So I titled the stream "Investing Isn't Rocket Science." So the big thing about it is that everyone sorry, I was make sure my phone was on vibrate. Big thing about investing is that everyone thinks it's complicated, and to be all honest with you, really isn't. So hopefully I can debunk a lot of those issues that you may have misinterpreted about investing, or didn't understand. But what I'm gonna go over is sort of the investment vehicles that you have, that you can utilize to ensure that you're set up and that you can continue to build wealth. Okay, that's been the subject for a while. But first, today was a good day because I started receiving you can see it, the first of my Financial Mirror apparel. So if you haven't seen it, I finally got, I'll show you the store up. Everything is pretty much in there. So I got the store up. So if you go to financialmirror.org, you've got up here in the top right, you've got the store. You can go right there, and so you can see all of the apparel that I've got in here. So I've got some shirts coming for myself, I know. So I'll be able to put one of those on. Everybody will get to see them live. The one thing I wanted to show is that this support tee right here, I made this specifically for those that want to really show a little extra support to the stream. What it is you can see is $4.95 more than the other, and the only difference in the two, the fronts are the exact same. The only difference is if you can see the back, it's got all the social media handles across the back. It's the only difference. But what it does is just as you're wearing that out and about, it just shows a little love for the stream. Lets everyone see where they can find out more about the Financial Mirror when you're out and about. So that's the only difference in the shirts, right? So if you see the $4.95 difference in this one, and it just comes in the black and the gray and the white. So if you see that, and you want to purchase it, hop on financialmirror.org and grab you some gear. But yeah, so I'm still waiting on my shirts to come in, but I got a face mask in light of COVID-19. I decided to go ahead and grab one of the face masks. I made face mask on there. So obviously you can't go anywhere without your face mask. So what better way to show off the Financial Mirror than with a handy dandy face mask? So hop on financialmirror.org, grab you some gear, start showing some love to the stream when you're out and about. Much appreciated. So let's hop right in. So the big thing that I've got today is to talk about this investment thing. So for the past couple weeks, if you've tuned into previous streams, for the past couple weeks, what I've been going over is a lot of going through, starting out sort of with your if you can see a timeline or a progression through this. We started out simply with going through your income and getting your first step in budgeting, and your first step in that financial report card, and moving into starting to build this wealth thing, this I don't want to use the term abundance, but it's where you can begin to start to do a little bit more with your money than just stick it in a savings account. Okay, so that's the whole idea behind this today, is that we can go ahead and start trying to show you some of those investment vehicles, some of those wealth building vehicles that you can begin to jump into, that you can begin to put your money into, that you can start to build that wealth. So the first thing is, when should this happen? So throughout the whole entire time we've talked about getting extra money, right? So when should this happen is pretty simple. There's a couple of items that I want you to remember. First is creating a nice little rainy day fund, nest egg, whatever we want to call it. Making sure that is the first thing that you establish, because if you haven't established that and something goes wrong, what's going to end up happening is you're going to have you're going to be out and about. Something's going to happen. You're going to need that little extra. Car breaks down, hospital bill. Something's going to happen, and you're going to need some money. And what we don't want you to go to is start to reverting to using margin or credit cards or some kind of loan. No payday loans. No pawning. No all these gimmicks to help you get short, quick cash. We don't want that. So the first thing before we start this whole investment avenue is to get a little rainy day fund. 3 months minimum is the guideline that I would recommend. 3 months of your expenses is what that is. So if you had to go out and you were jobless for 3 months, you would still be able to live. And that's key. You may have to decrease the amount of expenses you have, but that you can still live. Okay, so that's the first thing. The first thing is having a nice nest egg or rainy day fund before you start this whole investment thing. The other thing is that you should already be contributing 15% of your household income to a retirement investment account. Okay, so your retirement account is an investment account. And I said it is an investment account. 401ks and IRAs are investment accounts, as the baseline of them is that they invest into stocks. Most of them, they invest into funds. And we'll talk about how that sort of works, how you can get involved. But after you have those two things, you have a rainy day fund and you're contributing 15% of your household income to a retirement account. And I'll show you some differences. I'm going to go over 401k and IRA. I know I've gone over it before in the retirement piece, but I'm going to show you a little bit more in depth of how you can establish and set these things up. But the biggest thing is that then and only then you should start investing. So if you haven't done those two things, don't rush. Take a break. All right. Don't rush. And then we'll start investing. Come back and watch this later, but then start investing. So first and foremost, and those are sequential now. So they should go in that order. They should go rainy day fund, 3 to 6 months expenses, retirement, 15% of household income toward retirement, and then start your individual investments. And maybe I should clarify that the big thing that we're looking at is individual investments. We're not looking at your retirement investments, the individual investments. So next thing I want to hit on is that with this, you want to make sure that you're budgeting out. So in your budget, that you're creating this line item in your budget for investments. So you're setting money aside to where you have that little bit of money that you can use for your investments. So if it's $500, if it's $1,000, if it's $20, like just budget it and you'll be fine. So the big thing that I want to bring up here, and this is I've kind of I've had to think hard about what all I was going to cover, because obviously I'm fully invested in the stock market. I have a IRA account. I have my 401k. I manage those myself in a sense that I decide what money what funds my IRA invests into, individual funds, not broad scale. Like we'll go over some of the fund types, but individual funds of what I'm going into. So I'm not going to get that much detail. Okay. I really want today to focus on the overview of to sort of give you an idea of what to start looking at. This is going to be a very holistic view that I want everyone to see. And then once we establish this, I'm going to give you a couple of things for you to look into. But I want to give the precaution. I'm not a financial advisor. I'm not allowed to give you financial advice. I'm not allowed to, in a sense that I'm not allowed to tell you what stocks to buy. I'm not allowed to tell you all these things. I don't hold a credential that allows me to do that. What I'm going to show you is how you can begin to this journey of investments. And like I said, this is a wealth building technique. Obviously this is a wealth building technique that anybody can do. So if you've got the extra cash, you want to start putting this towards your wealth building, I strongly advise it. I strongly advise to start looking into growing your wealth this way. So the biggest reason that I recommend this avenue is most importantly that you can use any amount of money. I said you can use $20, you could use $5, you could use $10, you could do $100. Like this is such a crucial little piece that this allows you to begin to grow a nice little bit of income on the side, kind of. So but the word income, I don't want you to think of as like a monthly income, because unless you plan and your goal is working on becoming a full-time investor, your mindset of this whole entire thing should not be that I'm investing so that I can earn income. Okay, it can be a little side hustle. It could be, but what I really want to push this point across is that unless you're going to be a full-time investor, you don't need to budget. This shouldn't be income in your budget as a consistent line item. And I say that to say, use this as additional income. Like if you earn $500 and you want to put the $500 towards your mortgage or whatever, use it in that sense of income, but don't budget yourself to say, I'm going to make $600 in the stock market this month, or I'm going to make $600 off selling my mutual funds this month, because you're going to set yourself up for failure in that sense. So that's really the big point that I want to start out, and I want to make sure that everyone is tracking, that you understand, because nothing is guaranteed. Nothing is guaranteed when it comes to investments. Anything can happen. For anyone, today is November the 9th. For anyone that does anything with the stock market, you saw today there was a huge gap up in the stock market that and a lot of it probably due to the COVID 90% effective rate of one of the COVID experimental vaccines, but there was a huge growth in the stock market today. So that was not planned. That didn't just, you couldn't have planned that to happen. Okay, so that's where I'm getting at. Your budget cannot incorporate this investment income. All right, so I'm not going to beat that up anymore. But why you should be using this is not just for wealth. It's because the average, I'm going to give you average returns on all of these investment vehicles today. But I want you to remember is the inflation rate. Look this up. This is something that is tracked, and I'll show you. If you go to Google and you just search inflation rate US, you can pull up and see. So right here, the annual inflation rate for the US is 1.4% for the 12 months ending September 2020. It was 1.3 before. So this is the reason why investing is such a big thing. It's such a crucial thing, because when the inflation rate is going up 1.4% and you've got money sitting in an account that's growing at 0.75%, how could you ever keep up with the rate of inflation? You can't. You can't. So at 1.4%, if you're not earning 1.4%, your money is technically almost depreciating, right? You've got to be able to keep up with the rate of inflation. And investing is not gambling. You're not gambling to keep up with, like, I understand savings accounts are secure, but a savings account is simply an easy way for you to put money in a shoebox. It's a modern way to put money in a shoebox. It does not keep up with the rate of inflation. Savings accounts do not. There are, these have dropped due to COVID, but high yield savings accounts, if you look that up, look up high yield savings accounts. Here we go. Let's look at this one. So high yield savings accounts. This is the best savings rates that they're tracking, 0.70. So you're looking at about half of the inflation rate on this savings account. This rate's as of October 30th. So you can see these right here are the highest. These are the highest yield savings accounts that there's currently available. And the inflation rate is 1.4%. So this is the reason why it's not just investing as a wealth building tool, but the only way to truly build wealth is to grow your money in some way, shape, or form. Okay, so it's crucial we get involved and begin to do this process. So there's a lot of vehicles that I'm going to go over, but 401k and IRA is I'm going to retouch. Okay, so 401k and IRA, I'm going to retouch on these. So average returns. So average returns for 401k. All of these numbers are based, once again, off of looking up. You can always look this kind of stuff up. Average 401k return. So it's around 5%, 6%. There we go. Many retirement planners suggest typical 401k 5 to 8%, 5 to 8%. Bunch of different reports. 5 to 8%, 8 to 10% on this one. Just over 7%. These return rates can be tracked. So coming up with knowing that your 401k is doing an average return of 5 to 8%, that's a great vehicle for you to have in your retirement. So this is the reason why I've voiced during the retirement planning video is to really utilize 401k. So I'm not going to get on all that. I'm just going to go over the return. So 401k average returns 5 to 8%. The IRA return is about a 7 to 10%. Okay, 7 to 10%. 401k is 5 to 8%. The reason why, well, someone would say, well, why would I put all my money into why would I put my money into a 401k when I could just stick it all in an IRA? Well, you can't. And if you watch the retirement planning videos, there's limits to the amount that you can put in. So $6,000 for most, $7,000 if you're over 50. So if you can max that out, that's great. 7 to 10% on average return, that's great. Phenomenal for you. You maxed out the 6,000, 7 to 10% growth. All right. How do you invest in your 401k? First place, or the only place, go check with your company that you work for. They're going to have some kind of, they're going to have some information on how you can get involved. I wrote down a couple of the major platforms that companies are using now: Charles Schwab, Fidelity, ADP, Vanguard. A couple of avenues of who's offering 401ks to a lot of bigger companies now. As you get down into smaller HR departments, they're probably going through another company. But that's probably some of the top ones right there. And then IRA accounts, platforms to use, mostly like Fidelity, TD Ameritrade, E-Trade, Ally Invest, Charles Schwab. Your bank, your local bank probably allows you to do IRA investments. But the things to look for on these is you want to look at account minimums. So some IRA accounts require you to first off have an opening minimum, and some will require you to have a maintenance, like a certain level at which you have to maintain your your account. And then the other thing is a commission. You want to look at commissions. They'll also be called management fees. Look at that structure of how that certain IRA account is structured, and then base your choice off of that. So just shop around. You can move these just like you can move broker to broker, company to company, wherever. All these are technically going to be your brokers. So look around, figure out, and go with which one gives you the best option. So out of these two, so between collectively these two, what I would recommend is 15% of your household income annually. All right. So very crucial that you can hop on board with that. Is 15% annually. If your 401k could be pre or post tax, so look into that, and then that'll be made directly through your payroll deductions, and then your IRA is a post tax option where you will put money into it after you've taken your income home. Throw into an IRA account. Like I said, $6,000 a year is the current amount as of November 9th, 2020. $6,000 was the amount. $7,000 for 50 or older. So look at those options. All right, I'm going to give you a breakdown of how this should look. Okay, so we're going to go to our, you wouldn't guess it, we're going to go to Google Sheets, because that is where I will do all of the calculations. So let's see, I have to be logged in. All right, so it looks like we have to be logged in. Too easy. So let's get logged in. Boom. All right, so we are logged in. All right, so this is how this works. This is how this whole thing should be. Okay, so let's look at someone income. Let's look at someone with a $50,000 income. Okay, so $50,000. And as I've said on previous videos, I try to do all this live. So if you need to stop me, pop in the chat, stop me, tell me what I said didn't make sense, and I can go from there. So at a $50,000 income, we're gonna have our 401k, our IRA, and this will all make sense in a second. 401k. So in that order: income, 401k, IRA, 401k. Like I said, it'll make sense in just a second. So the first avenue, so let's say your company, I work for whoever, and they match 4%. So the first thing you want to look at is you want to figure out how much your company matches for 401k. Step one. First and foremost, find that out. So if they match 4%, what we're going to do is we're going to multiply this times our 4%. All right, so that's giving us so this is going to be our total invested annually. All right, so total invested annually. Okay, like I said, the reason why these are in this order will make sense in just a second. So now, IRA, the IRA account. So actually, let's do this. So I need to know. I don't know the best way to present this. What do y'all think? So okay, let's do this. So let's do this. This will be good. So delete that row. So the most that we can put in is $6,000 annually, okay? So let's do this. Let's do this equals this divided by 50,000. And we want this to be a percentage. Boom. Okay. All right, can we do this? Boom. Okay. So we want this to equal the sum of those. All right. So the goal, like I said, is 15%. All right. So now I've got this set up. So if you missed any of that, go back and see what I did on the formulas. Pretty much, I'm trying to create this calculator for you to easily be able to calculate your 401k and IRA contributions off of your income. So if you put in on this field, pretty much what I'm making is these are the editable fields. This is what you would edit. Okay. You would only edit these, and I'll explain why in just a second. So if you did those as your edited fields, this is how you could use this calculator. So if you made $50,000, I want us to know how much we're investing annually. So let's do that. All right. So 16% is $8,000. Okay. So what I want you to see is this. If you wanted to invest 16%, all for it. The more the merrier. This allows you to max out your IRA and get full matching. Okay. But if you want to be stingent and you want to be like, hey, you know what? I don't want to do 16%. I want to do 15%. You said 15%. Let's do 15%. So what I just need to update is this yellow field to where now it equals 15%. So this means I'm going to be putting in the full 4% match on my 401k, which is going to equal $2,000, right? I'm going to put in $5,500 into my IRA account, and that's going to give me $7,500 invested annually. Okay? And I'm going to show you this whole big round circle. But this is how you adjust this. And if you're not doing this, please, I'm truly recommending you to do this very one thing is right here. So let's say your income goes up. Oops. Let's say your income goes up to $60,000. This is how you adjust this. Now you're only investing 13% annually, right? So let's bump this back up. We know the most we can invest is $6,000, right? It's the most that we can invest. So let's come back over here, and we've got a total of 14. So we need to make that 15. So we're going to put a 1 right there, and this is a percent. So not 100%. This is going to be a 1%. All right, 1%. So now we got 15%, and we're investing $8,000 annually. You see, or $8,400 annually. You see how this is working. So with this little spreadsheet that we threw together, all we have to update is our annual income. Here we put in the matching percentage of the 401k. That spits out how much we're investing to our 401k initially. So actually, I take that back. I'm wrong, because now we got to do this times 1%. That's how much we're investing annually. Boom. So if we update these yellow fields, so this is 4% matching. This is just calculating this divided by this, knowing this is the max that this can be, right? 6,000. And then this. As you go up in income, so let's use someone that makes 75,000. If our matching is still 4, so in this block, I would only put how much is being matched. So if 4% is being matched, that's what I'm putting in that block, okay? So if 5% is matched, now you can see I'm only doing 14%, so I need to go back to my 401k and add more. You tracking this? Hopefully everybody's picking this up. If you're not, throw in the chat that you're not getting it, and I'll break it down further. But this is how you use this vehicle of 401k. This is your first step to investing, is to hit up this retirement investment accounts first, 401k and IRA, and this is how you come up with it. Figure out your total income, take the percentage of how much is being matched, okay? max out your IRA, and then whatever's left, in this case, by doing those two things at a 5% match, most companies are going to have a 5% match. Let's do a 4. Most companies are even 3. So at a 3% match or a 4% match, plus max out the IRA at 6,000, we see we're at 12%. So we can still do 3 more percent at 401k. So that means you're going to end up with your 401k is going to be getting a 7% contribution, and your IRA is going to be getting maxed out at 6,000 annually. Hopefully that makes sense. But that's how this strategy works. You work this in this order: 401k, the matching amount only. How much your company matches. 401k, how much they match, right? All right. So how much they match? Just like that. And this is all you have to do, and life is great. Okay. So do those two things, and then like I said, this keeps going. $100,000, 4% match, 6,000 annually. You're still only at 13%, so we need to go up to 5%. 15%. You're putting in $15,000 because 15% of $100,000. Okay, I'm not gonna beat this any up. Okay, if you need help with that, email me. Contact form at the bottom of financialmirror.org. Let me know, and we will we'll go through it. But this is just a little calculator that'll help you. Should probably save this so if anybody ever needs it. So 401k IRA distribution. Boom. So I've got that in my Google thing. So if you need it, I can upload them so you can utilize it. But anyways, that's that. Hopefully that made sense to everybody. Moving on. All right, mutual funds. Mutual funds. Let me get this set up. I'll be right back on that. Let's get it. All right, be right back. Let me get this the mutual fund one. All right. So the mutual funds. Here's the big thing about that. Oops. Let's go back. So with mutual funds, your big piece for mutual funds is going to be that mutual funds are going to provide, on average, like I said, let's look at this up. I told you I'm going to look all of them, so you can see mutual fund average return. If you're looking at investing, you'll want to sense the average, blah, 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 roughly 13%. So 13% of your mutual fund will get paid back, or you'll profit off of. So 15%, or roughly 13%. So remember that if you're consistently earning 13% of your of this strategy right here, you will continue to build wealth. Okay, so 13% year over year, you will build wealth. So it's very important that you jump into, first off, your 401k and IRA. Second off, you jump into the mutual funds. So mutual funds, for your IRA, this is going to be sort of the same platforms that you're going to use. So Fidelity, TD Ameritrade, Ally Invest, Charles Schwab, your bank. But once again, you're going to be looking at commissions on these. So look at the commissions, see what they're charging. The biggest difference is that if you're going to open an IRA account, you've got to also open a non-IRA mutual fund account. There are two different things. Remember, the IRA account you can only do $6,000 into. So if you want to be investing in mutual funds, you need to open up a non-IRA mutual fund account. Okay. So open that up and start browsing. Biggest things you can look at is knowing the 7 common mutual fund categories: money market funds, fixed income funds, equity funds, balanced funds, index funds, specialty funds, and fund of funds. So all of those different mutual fund assets. However, what I want you to remember is you have large cap, mid cap, small cap stock funds. So that's the terms that I want you to remember. So I went over the other ones, all those 7 category funds. Not as much needed. Knowing what, if I have an equity fund or an index fund. Remember large, mid, small cap stock funds. They give you a lot of idea of how much the average market capitalization is. So that's nothing more than how big the size of these companies are that fall under that fund. So if you can imagine a fund structure. So I'm gonna try to pull up a picture of a fund structure. So a mutual fund structure diagram, that might work. So pretty much this is not that kind of structure. So let's see if we can just find. So let's see, is this pretty good? So this is all no, that's just the types. So what I want you to think about for a mutual fund, right, is a lot of this is more of an example of what a mutual fund is. So this would probably, looking at this, is probably like a large cap mutual fund. So all these people, all of these companies, someone would put together this fund of all these companies, and they would say, this large cap, whatever, growth fund, value fund, blend fund. Growth fund is obviously it's going to grow at a faster rate. Value funds are going to be companies that are currently trading or companies that are currently valued, their stock is trading less than what the company is technically valued. And then a blend is going to be a blend of the two. So value and blended funds are sort of a low to moderate risk type of fund. Your growth funds is a moderate risk type of fund. And then an aggressive growth fund is going to be that high risk, high return. So that's the mutual fund that you would look at in that sense. So that high risk, high return mutual fund as the aggressive growth fund. So if you look that up, so if you were looking at mutual funds, so Morningstar is a play. So you can see, like, let's look at mid cap. Oh, so I finished loading in, like mid cap. So pull this up, and what you can see, this is the growth rate of the mid cap. So here you can look up specific funds that are out there, and Morningstar rates them. Okay. So knowing that, if you were looking up, like if you went into your, let's look up aggressive growth mutual funds. So let's look at what Yahoo Finance has. 4 best aggressive growth mutual funds. Wonder who's putting these out. So here you go, Vanguard. So these guys, so pretty much all these people right here have developed these funds, right, which are made up of a bunch of stocks or bonds or whatever, and they right here, returned 8.3% the past 3 years. Has returned 19.1% the past 3 years. 23.5%, 22.1%. But these are nothing more than a group of stocks or bonds that are being managed by someone else, and you're investing into that fund. So that's how that works. That's how mutual funds work. That your IRA account is probably set up with where it's buying into a mutual fund, and it's important that you understand that you don't, like Charles Schwab, for instance. If you had an account with Charles Schwab for an IRA account, you could just go pick that you wanted to be moderate, high risk, moderate risk, low risk, whatever, and then they're going to pick what funds are available to you. So there's a hands-on approach where you're physically, like in that I just showed you, you're physically picking what funds you want to go into and invest in. And then you also have where you just pick a risk level, right? And then they pick what funds you should be in based off of your risk level. So with that, that's sort of going to lead me to this whole idea behind in this wealth building thing. So if you look at it, so mutual fund return calculator. So this is what I want you to think about. So let's look at this, and like I said, all of this is live because I want you to see sort of how you come up with this. Okay, so I want to go back. Actually, let's jump on this. So let's do this. So let's say we're starting at $0 today. So today you're going to start investing in mutual funds. I don't know why I did that. I want to sell off mutual funds. Let's say that if you're investing in them, actually let's stick around for some mutual funds. Let's do 10 years and hypothetical rate of return. So we saw mutual funds are 13%. So I'm going to do a 9% just to be on the safe side. And then before we were looking at a $11,000 whatever dollars for your 401k. So I want to scratch that. I want that to be going toward 401k. But what in addition to? So in addition to, let's say that we're going to use $200 a month for 10 years, 9% annually. This is the type of thing I want you to see. So at 10 years, this account that you started with $0 and you invested $200 a month, hypothetically, if you continue, so this is telling you that in 10 years, your financial situation didn't change at all. You were only still able to contribute $200 a month. I want you to see how much your investment amount is at the end, right there, $38,000. Okay. So you invested $24,000 and your investment grew another $14,217. This is the mindset. This is how you build wealth. This is how you build this growth of wealth is through these type of vehicles. And if you're not using them, you're missing the boat on that. Hitting back on it. If you're not investing 15% in your annual income already to a retirement account, and you don't have a good nest egg rainy day fund, work on those first, but then jump into this. Let's take the same example and let's use the college kid example that wants to buy a house at 30 years old. Let's say he starts at 18, he wants to buy a house at 28, 10 years, but he can only afford $20 a month. $20 a month, 9%. And I'm being generous. You saw some of them returning 20% mutual fund. We're being generous. We're going to say 9%. He wants to buy a house at 28, or 28. Look at that. Look how much my man made. Oh, sorry. It messed me up. Why did it, starting amount 0. I was like, that shouldn't be right. That's a lot. So 20% per month. There we go. Starting at 0. Look at that. That's saying he can only invest 20% for 10 years. This college kid is going to get a job when he gets out of college in 4 years. So let's take that. Let's go back. I want you to look at this. This is you can play with these calculators and make these things yours now. So college kid goes to college for 4 years and he invests $20 a month for 4 years. And this is the same buying a house at 28. Okay, so 4 years he spent in college. He invested $20 a month. This is how much he ended up with. Okay. So let's copy that. And I want you to move over. Now we're starting at that, right? Because that's what he invested. So now I want to use the same example. So 6 years, but he just got a job, right? And now he can invest $100 a month. And he started with that. Still wants to buy that house. Look at that $11,391,000 down payment toward his house. These are generous numbers. These are extremely generous numbers. But this is what I'm wanting you to see, that if you will invest your money, you can build wealth. If you will invest your money, you can build wealth. That's the whole point of this whole entire thing, is that I'm trying to be generous on the numbers. I'm trying to make it, and even being generous, you can still see the amount of money that you're missing out on if you're not utilizing these different avenues to grow your total net worth, right? So use them. Use the calculators. Go out there, have fun. This was Capital Group American Funds. Go out, find a calculator. I literally just searched mutual fund return calculator, Nerd Wallet. I don't know all these. Look at their return on investment calculator, ROI calculator. But go use these things. All right. Go out there, figure out how you want to invest, and go with it. Okay, what everyone is recently familiar with, but stocks is going to be the next thing I talk about. And I laugh and chuckle because I'm not going to go into the detail everyone probably was hoping I'm going to go into on stocks. And the reason I'm not going to go into that much detail on stocks is the simple fact that stocks are something that you can easily get yourself in trouble on. So mutual funds are generally safe in a sense that you just invest your money. Stocks have this psychological mindset to them where, so average return. So I've started every time with average return. So on average, the stock market has returned 8% roughly since 2000. So I'm saying since 2000 because you had the dot-com boom from 95 to 2001. But Goldman Sachs says in the last 140 years, the average return was 10%. Recently, it's not obviously that high, but I did an average return search since 2000, and the average return's been about 8%. So I'm going to use that as an example because obviously roughly 8% return is generous. I've given success story of a buddy of mine that had a return this year alone. He started just about a year ago, I guess now. But he did. I sat down with him for some time. We talked. I taught him some of the things that I knew. And he averaged this year. He had 100% return on his money. So if he put in 1,000, he got 2,000 back. If he put in 10,000, he got 20,000. So he doubled his money. But I say all that to say, I'd love to go through and teach every person the stock market and how it works, and I will. I'll do actually I won't, but I will teach you about the stock market. Oops, about to draw something over here. I will teach you about the stock market. But what I don't feel comfortable doing is I don't want you to get involved in something that you're not comfortable with. I guess that's what I'm saying. So is it a complicated, so first off, do people consider the stock market gambling? That they do. Do people consider it unsafe? They do. Is it risky? People say it is. But all of these things comes from their lack of education at looking at data, at looking at charts, at looking at financials, or just not really knowledgeable of how the market works. It's the only reason people can say those things. So Is it complicated? Yeah, kinda it is. It is. If this chart right here confuses you and you have no idea what's going on, yeah, it can look confusing. It can look daunting. And then let's add like Bollinger Bands, and let's add like the MACD, and let's add RSI, and let's start adding all these indicators and all these things. Add the VWAP to it. If you start adding all these things, it gets complicated and people don't know what they're looking at. And so that's when it's almost it's almost to at that time it is gambling. You have no idea what you're doing. It's easy to learn. So you can learn this stuff, and I'm tripping over my words because I really want you to know you can learn it, but don't jump into it blindly. Don't go in there by yourself, not having any knowledge, and just throw $1,000 at it, because you're most likely going to lose $1,000. There's a chance you win, but it is absolute luck that you won it. So don't think that you're an expert. I've been doing stocks for almost 10 years, but I'm not an expert. I'm not by any means an expert. So I'm constantly learning new things. So what I want to do today is I want to show you some of the things on the about a stock. More importantly, I couldn't get this to work earlier on this platform. Yeah, it kept crashing like that. So Weeble, if you're out there listening, please know that if I'm hitting widgets, you can see it's crashing like that. So anyways, maybe that's just on this one computer over here that I've got. But anyways, I'm going to go over some stocks. I'm going to go over what you're looking at, things to look at, mostly terms. I want this to mostly be about terms, because I want you to understand some basic terms to get you started. This is just to get you started. There's a ton of content out there to help educate you, but I'm telling you, invest in yourself and knowing that you need to be educated before you jump into stocks. You're buying individual stocks, you are at higher risk, in a sense that if you don't know what you're doing, you are at higher risk. So terms you've heard: day trader. A day trader is someone that buys and sells within the day. That's what that means. A day trader does not mean that you trade within days. Some day traders may hold their stocks overnight. Most day traders are buying and selling within the hour, minute. You can see on this chart, this is a 1 minute chart that I'm looking that I have up right here. This is a 1 day chart. So every one of these it shows a day worth of action. Weekly, monthly, quarterly, anyways, you get it. So yearly, you get it. That's all I'm going to get to on. I'm not going to go into chart reading. There's many experts out there that can teach you about charts. That's not what I'm here to do. I'm not here to teach you how to be a technical trader. I'm not here to teach you how to read financial statements. What I'm here to teach you what to start looking for so that you can begin to educate yourself around stocks. Okay, so let's clear that up. Day traders buy and sell within the day. Swing traders would buy, like right here. This would be a swing trade. So Apple has pulled back, right? The swing traders would say, okay, well, this I think is the lowest point it's going to hit, and then it's going to swing back up. So it does this like a swing, right? It does this. So if I go to any of these are just a couple: Google, Apple. Oops, I mean open that. But that's what swing traders would do. Swing traders would be like, all right, well, it's pulling back. All right, now it's going to swing back up. So trying to think of one that has done a big swing. GoPro. It's pulling back right now. So this would be a huge gap up right here. Now it's beginning to pull back. A swing trader would buy in down here and wait for the swing up. Okay. And then an investor is someone that's going to buy and hold for an extended period of time. Like this would be one: Ford Motor Company, ticker's F. This would be an investor. Okay, so let's go to like an investor probably looks at like a monthly chart, and they'd say, okay, well, look at this, all this action way up here back in like March or September 2014. this thing's pulling back, but now I can see it's starting to gain back up. So an investor may buy down here in hopes of that it recovering and getting back over here to this $14 amount, right? That's an investor. Someone that's, they're going to buy and they're going to hold and they're going to watch this thing rise. That's what your investors are doing. So understanding what kind of traders there are, swing trader, day trader, and then understanding what an investor is. An investor is buying in for the long haul. They're here to stay. So understand that, know that. This is only one platform. This is Webull that I've got pulled up here. Webull is great for trading stocks. So they have great charts. They have, if I could get the widget thing to work, I don't know, maybe like the paper trading widgets work, maybe. Yeah, they work. Let's try this. So you could set your charts up, and you could have, like, you could have some news down here. Let's put some news down here. How about that? You could do some news right here of what's going on. You could say, I could look at, I don't need that. I could look at analysts, what the analysts are saying. So this is all the SPY. So let's put that in there. Oops, didn't go like that. Let's do, that's pretty good. We'll do financial statements too. Okay, so just like that. So you could set up something like this, and then you could have your order entry. I would do it more like this. Your positions, anything you hold a stock in, something like this. Okay, so this is just a chart. It's got your, like I said, I put in analyst ranking, news. So let's go and let's look at a, I think you have to do it from here. So let's look at like Apple, for instance. Everybody likes Apple, right? So I go to Apple. This needs to be 1. 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 So everything I do shows for Apple. Analysts are not pulling up, but who cares? Neither is this. It's interesting. Oh, it didn't change. That's why. Because I had already put it in. So now 1's Apple. Now everything's going to pull up Apple. So this is showing you analyst price targets. This is showing you analyst ratings. This is their financial statements. This is their news, yada, yada, yada. This is the chart, the stock chart. So Webull's great. This one platform. The other I have up here is TD Ameritrade, Thinkorswim. I'm not going to go through all the stock charts. What I want to just do is go over what the terms mean and show you. So volatility. Volatility is another word you're going to hear thrown around the stock market. And the volatility is how volatile or how much the market swings up or down. So markets that are swinging up and down, big. So extremely volatile, BYND, today, Beyond Meat, today, extremely volatile. This thing had, this is a 1 minute chart. I'll say, whoa, extremely volatile. This thing had 19 million trades today. Extremely volatile. So big swings, big swings. So you've got more volatility increases the risk, because you don't really know where it's going to go, and when it happens, it can happen quick in a high volatile market. So knowing that is important. Price to earnings ratio. So this is the ratio to the value of the company. You can find that kind of stuff on whenever you see, this is all their financial statements. Where is their, back to widgets. Yeah, I'm not liking this crashing thing that Webull's doing right now. So anyways, let's do this. To go over these, I'm gonna pull up finance.yahoo.com. So let's look at like Apple. There you go. Oh, that's not Beyond. I wanted Apple. So right here, PE ratio. So this is the price to earnings ratio. So it just shows you the value of the company. So obviously The higher the PE ratio, it just means that the stock is expecting higher earnings in the future, higher earnings growth, or it could mean the stock's overvalued, one or the other. And that's the reason why if there was an indicator or a number that made stocks be guaranteed to move up, everyone would use them, right? So there's nothing that says that a high PE means that it's higher earnings growth in the future, and it also doesn't mean that it's overvalued. So you have to look into the company. A lower PE could mean that the stock is undervalued. So looking at the PE, if it's an undervalued company, let's see what the PE is of Beyond Meat. They did very well today in terms of money making ability. So PE NA, that means that they haven't reported earnings or they reported bad earnings. So you got to look at stuff like that, right? AMC, bad earnings per share is terrible. So earnings per share is the next one. So that comes from the PE. So earnings per share is company's profits divided by the shares on the market. So it's their profit divided by their total shares on the market is currently being traded. So look those up. That's good indicators of a company, of a company's sort of what's the word I'm looking for? I guess a company's current like status or current. I don't even know the word I'm looking for. Went completely blank. But it's sort of how a company stands financially. Are they very well off or are they struggling? So that's something to look for, is that earnings per share. So look for that and know what that is. And then finally, look into the company and see what the company is about. So there's different types of trading, right? So technical trading is one. Buying off of financials is another, but like things like Finviz, you can see. So like if we looked up Apple, so you have all these things about Apple, right? All of these things. They've got their PE over here. They've got their earnings per share right here. So look at these things and you can see how good the company is financially. And you're probably like, well, how do I even find stocks? Well, screeners help you cut down on stocks. But the thing is once again, none of this is meant to be your one-stop shop to learn how, but to buy stocks. I'm not here to teach you how to look, and this isn't what this video is about, but looking for stocks is very easy once you're educated and know what you're looking for and you know what you're trying to buy. But you have fundamental and technical trading. So looking at the two, one of them is going to be better than the other. Technical trading focuses more on chart reading. Fundamental focuses on things like those PE ratios, earnings per share, sales growth, earnings per share growth. Things like that is gonna drive any fundamental trader or investor. So look at those things. Invest in educating yourself on stocks if you really want to get involved in stocks. There's this term called puppet trading that just means that trading a stock that someone else told you. If I told you a stock right now and you went and bought it, you would be puppet trading me. I would be the one behind the puppet and you would be the puppet, right? So don't puppet trade. It's an extremely risky strategy. And the opportunity in stocks to lose money is quick and painful. It is quick and it is very painful if you put a lot in. So with that, I truly want to advise against just jumping into the stock market. We went over mutual funds. We went over your 401k and IRA, setting those up. But I strongly suggest that you stay out of buying individual stocks unless you're educated in the sense. Don't just buy individual stocks because someone told you that the market's going great and you can make a lot of money. Okay, so stick to doing taking vehicles, using vehicles for your money that can help you grow your increase your wealth. But and the stock market's great. I play the stock market myself, so I'm not advising against stock market, but I do tell you to educate yourself on the stock market before you just jump in. Okay, that's the only thing I'm saying. So with that, nobody in the chat popped in, had any questions for me here at the end. So I appreciate everyone that decided to watch. I know the stock part, I was a little all over the place with my words, and I apologize for being all over the place with that. I do want you to know that I just don't want you to get involved in something that you're not educated around. So if you're not educated with the stock market, please don't jump into the stock market. I don't want you to lose money and come back here and say, well, you told me that if I looked at a high PE ratio, that meant that they had a high growth earnings chance, and then I lost $5,000. That's not what I want. So I truly want to advise that utilize those mutual funds, utilize those that 401k and that IRA to get involved in wealth building, and then take that and invest in education for yourself if you want to get involved in stocks. And I'm not saying read books. I'm not saying read more stock books. I'm not saying listen to more podcasts. I'm not saying watch all the YouTube videos. YouTube videos are great. There's a lot of great free content out there, but you may end up having to buy an actual class where someone can help you learn the process. So don't get involved with wasting money, but please don't throw money away too. Just trying to see, what's out there. So with that, I appreciate everybody coming and watching the stream today. Next week I'll be back on Sunday. I've got to come up, if y'all have any ideas, let me know, but I've got to come up with a way to do this this reserve thing and be able to stream, and I'm trying to get it all on the same day. I just don't know what they really are. So I'm going to continue to work on that. I don't know if it's just to do a Monday, maybe later afternoon stream, or that might be my best bet, or I like the Sunday thing. I really like doing it on Sunday, but maybe I have to do like a Monday at 3 p.m. That'd be 8 Central, or no, 3 would be 7 Central, 8 Eastern. And maybe that's my route. I'm not sure. So I'll work on that. I'll figure out the best time to do it. But once again, I appreciate everybody watching the stream today. And I look forward to seeing you next week. Peace.